Okay, this is where we last left off. We're getting to something called cost recovery methods. It's the opposite of percentage of completion and completed contract, where we're recognized, or it's not the opposite of completed contract. It's the opposite of percentage of completion. Percentage of completion, we're recognizing revenue before delivery. This is after delivery. We've sold the product. It's gone by all stretches. It looks like it's a completed sale, but we're not recognizing the revenue. Why? Well, in the two methods we're going to look at, which is this is where we last left off, the installment method. That's the first one, which is also after delivery. The installment method is also after delivery. The reason why we're going to hold off recognition of revenue is because we have a doubt as to collection. That's what the whole amount is, a doubt as to collectability on the sale. So the installment method is illustrated in the textbook and in these slides, and you can go through. I'm going to do a quick illustration, the sort of the Professor Sam shortcut methodology method of looking at how it's done. And by the way, make no mistake about it, but the tax accountants love the installment method where the tax law allows for it, because it's delaying the revenue recognition, as you'll see. So what happens is you have a sale, let's say it's $200,000, and following sort of the textbook approach to part of this example, there's a 25% gross profit built into the sale, so the profit's going to be $50,000. That's the gross profit. Cost of goods sold is obviously $150. And what the installment sale does is it says recognize no revenue until money's collected. However, when money's collected, what you'll do is you'll recognize on each dollar collected, as you collect it, you'll recognize 25% of each dollar as revenue. And here's how you set it up. You set up a receivable for the installment sale, $200,000. That's certainly a debit. And then you set up an installment sale account where you record the sale for the 150, which represents the inventory. So you're really getting the inventory out when you make that part of the entry, and you'll see the details in the textbook. But the balancing, which is what I want to show you, and then we'll just go through how that balancing entry works. The balancing entry, as you can imagine, and my handwriting is just going to pot here because of the angle with which I'm sitting. So let me just kind of redo that a little bit. The deferred, I'll just label it DEF, deferred revenue, REV, and the deferred amount is the gross profit of the 50. So that gets put in a liability account. This is a liability, and it stays on the balance sheet in the liability section, and then we'll see what happens. So what will happen is the following. Let's go to some space here. As we collect on the 200,000, let's say we collect 60, so 60 will come in, that'll be a debit to cash. We'll credit the receivable for 60, and since we now collected this much, we know we can release some of the deferred liability, deferred revenue, the liability account deferred. We can release some of it to profit. So we'll then debit the deferred revenue, and the key is to how much, because the credit is going to be the revenue recognition as we collected the 60,000. Well, the gross profit percentage said it was 25% on the dollar. That translates, if we collect $60,000, that translates into $15,000 gross profit we just made at the time of collecting that $60,000. So that's what we'll do here. It'll be a $15,000 to the gross profit, the revenue, and we'll release $15,000 from the deferred revenue. So in this case, if we were doing T accounts, we would have a deferred revenue account set up at the time the sale is made. We put the entire amount there as a credit balance, the entire amount of expected gross profit. As we collect a dollar on the receivables, we'll take 25% of that dollar and debit the deferred revenue and put the credit balance to revenue. So here's our revenue account, T account, so revenue will become 15 as in that entry. And then we'll do the same thing every time we collect. 25% of each dollar will take off, so that by the time we collect $200,000, that's the total receivable, recall. So by the time we collect that, 25% of that is our gross profit that we were supposed to have, the $50,000. So the deferred revenue becomes zero after we've collected the entire amount. So it defers the revenue until we collect the whole amount, but we recognize some of the revenue as we go along. This is one of the theory, and by the way, GAAP doesn't like this unless you have certain circumstances, and I think they spell that out in a slide. Let's see if they do that. Maybe they did it here. I just know GAAP doesn't like it. Yeah, here you go. It's the profession concluded that it's not a good idea to accept in certain circumstances, otherwise it's not acceptable. So you have to have a situation where there's some rationalization you can hang your hat on, and this is my theory in my own language, that we have some doubt as our ability to collect the entire amount. So what we want to do, and even that it may take a long time to collect because the customer's just got issues. So what we want to do is defer the recognition of revenue until we collect each dollar, or as we collect the dollars, and then we'll record the revenue. This is a intermediate step, so to speak, before you get to the final part of this chapter, which is the cost recovery method, which accountants love even more, because the cost recovery method, now being demonstrated in this part of the chapter, is still an after delivery, but it's even more so than the installment method. Here, you've got a situation where your collection of the account is even more in doubt than the installment method theory was. This is one where you don't expect to even get back the cost of goods sold. You make it. Why does it happen? Well, you don't do it deliberately, but you make a sale, and the next day you find out that the customer is going bankrupt or something like that. So you then begin to say, well, we may not collect even the cost of the sale. We have no idea. So we delay the entire revenue recognition until after we've collected the cost of goods sold. So we have to get back 100% of the cost of goods sold. And at that time, after that, what we do is then we start recognizing the revenue. And since we've delayed recognition of any revenue until after recovering of our costs, each dollar after that is revenue, because there's nothing left to charge it to. So the deferred revenue sits in deferred revenue, the $50,000, until we've recouped, in our example before, the 150. After we've recouped the 150 in cash, then if we collect 10,000 more, all 10,000 becomes revenue at that point, and so on until we collect the whole amount, if we do. That's you can imagine that, again, tax accountants love the installment method where allowed. They love cost recovery method where allowed under the Internal Revenue Code for the same reason, because you defer the revenue until later on. And deferring revenue, in case you didn't realize it, deferring revenue is always a great idea in tax law, because the longer it takes to pay the tax, the more you can do with the money in the meantime, and maybe you come up with another tax deduction to further shelter it. Okay, one more, I think it's one more issue with revenue recognition after delivery. This is where it's in the language called the deposit method. What happens is you get a deposit for a sale, but the sale's not done yet. This happens a lot in your own lives, I think. You put money down, but the sale's not complete. So the seller doesn't recognize the revenue until the sale is complete. That's the basic idea. And they give you some illustrations, or no, this is just a summary of the whole thing. A typical example of this, which will be in your own lifetimes, and then I'll think we'll be done, is accounting firms, law firms, professionals get what we call retainers. I'll tell you one reason why we do this. A new client walks in our office, we don't know the heck about them. So we want to make sure we're going to get paid, so we ask for an upfront retainer where they'll give us a lump sum. Maybe they'll give us $10,000. And what we do, we tell them is we'll bill off of that. That's what we sell. We'll bill off of that. So as we bill, let's say we bill $2,000, so it comes off the retainer. And we recognize the revenue as we bill it. In the meantime, on our balance sheet, it's a liability, because they could come in the next day, and this is our agreement with retainers. They could come in the next day and say, I want my money back, I'm done with you guys, and we'll give them whatever balance is left. So that's the idea of the deposit method. And I think that's pretty much it. You can look through the rest of the slides. The appendix that you got to concentrate on, I think, is 18B. Let's see if it's here. It's in your textbook under 18B, because in this slide, the percentage of completion was included in the chapter. That was the old chapter. In the new chapter, they put it as an appendix. And that is it. Notice the copyright, whatever that means. Okay, thanks a lot.